Hello, everybody. This is a presentation on how to sell options. It's a relatively new tool for the retail investor. Why sell options? And this is the graph of the S&P 500, the Standard & Poor's index of 500 stocks. And in 1999, the S&Ps were $1,500. And 8 years later, in 2007, they were $1,500. And then 6 years later, they were still $1,500. That's 14 years of going nowhere. And that is the reason why selling options can be profitable. Let me walk you through a few things. Let's get started. I opened a brokerage account when I was 23 years old, and I began my amateur career picking stocks. For real. I read books. I studied the financial results for thousands of companies, and I made spreadsheets, and I ranked every one of them. And I'm serious. I ranked every one of them. I still have the spreadsheets today. I was ready. The big day came, and I bought stock. And then I lost money. And I learned that the companies, my companies, were not the high-flying stocks that Wall Street loves. So my stocks went down in value. And it turns out that picking a good company was easy. You can just read these books and find what a good company is. But picking a good stock was very difficult. Fortunately for me, I had 4 kids. I didn't have any more money to invest in stocks, so I would have to wait until later to see if I could pick a winner. 25 years later, I resumed my career picking stocks, or should I say I was investing in select companies, these companies that I reviewed. I listened to earnings, to the CEO talk about their earnings on a quarterly basis, etc. You thought I was using the same criteria that I learned from Peter Lynch and Warren Buffett, those books that you saw a second ago. But to no avail. My stocks went down in value, even though my selected companies' profits went up. Wall Street didn't like my companies, and I felt bad. I was losing money. I loved my companies. I had good companies, but they were bad stocks. And then I talked to Richard one day. He was over at Claire's, and he said, "Well, I don't care if the market goes up, down, or sideways. I make money either way." And I thought, that's impossible. How? And then Richard explained to me a broader scope of investing, and I am forever grateful for him spending hundreds of hours with me, teaching me the principles and teaching me the mechanics and the software. So thank you very much, Richard. Nice job. I want to start off by saying I am not an expert. And by the way, there are no experts. If you give your money to somebody else and they claim they're the expert, they are not. Nobody has a crystal ball. Separately now, the press likes to assign a cause for market gyrations, but most of the time it just ain't so. Look below here. Why would the stock market, with trillions of dollars under management, be affected by Greece, a country with the population of about Ohio? It's silly. Look over on the right. On a day when all this great news occurred, look at Amazon surpasses Walmart as in market cap. Starbucks sales surge 18% in the third quarter. AT&T beats their earnings estimates. Jobless claims plunge to a 42-year low. On a day with all of this great news, the stock market went down 1.07%. Not a big move, but nonetheless, it's just crazy. The press will assign a cause. They'll pick something out and say, oh, here's why the market went down. It's not true. A free and open market in highly liquid assets will gyrate up and down for no reason whatsoever. Anyway, the final thing in the introduction here is I used to talk to my kids about money like my parents talked to me. You know, the old saying, shut the front door, we can't heat the whole neighborhood, or turn off the lights, money doesn't grow on trees. So hopefully this will initiate a level of discussion about the details and mechanics of investing that will help benefit younger people. So let's talk about markets. Just one slide on markets. There are money markets. You can simply put your money in the bank in the form of a certificate of deposit. You could buy bonds, which at certain times may not be a bad idea. municipal bonds, corporate bonds, junk bonds, whatever. You can invest in futures. You can invest in the future price of oil, gas, pork bellies, orange juice. Remember that movie? If you haven't seen the movie Trading Places, a great movie to watch. Um, Trading futures in orange juice. Um, or maybe it was oranges. I don't know. You can invest in the foreign exchange forever. That bank that took the place of Russo's Candy on Route 1, for like 2 or 3 years, they had a sign that says, "We have euros." Okay, great. You could invest in private equity, privately held companies. You could invest in antiques like 76 Vincent Street, put your money into real estate. You could buy precious metal, gold, silver, platinum, whatever. You could go out and pick your own stocks like I tried. You could pick very good companies and their stocks may go up. 3M, Scott Hagermose's company, a great company. Been around for, I don't know, probably more than 100 years. You could buy a high-flying brand new stock, relatively speaking, like Facebook. Or you could buy an old, what is becoming a stalwart, Microsoft. They make money hand over fist, but the stock goes nowhere. I owned it for years. You could own another high-flying stock like Apple, great company. You could just take your money, put it into mutual funds where somebody else picks the stock. You buy one fund with a certain objective, and then somebody else is responsible for actually picking the stocks. Or you could just go out and select an exchange-traded fund, which trades electronically. And here again, it's an index. And in fact, that's what I have found is a little easier. I'll show you later. Let's talk about something different now. Let's talk about car insurance. We pay State Farm for my car insurance. I don't know exactly how much it is, but let's just say it's $730 a year. That's about how much it is right now. They collect the insurance premium, so they are the sellers in the contract. They get the money from me, so I'm the buyer in the contract. And if nothing bad happens this year, then I lose my $730. But if I get into an accident, I still lose the $730. But they cover the damages up to a certain amount because they said in the contract what the maximum amount is that they would cover. So since the premium is $730 per year, State Farm therefore collects $2 a day. Let's call that theta, for the lack of a better word. If I cancel my insurance halfway through the year, then I get $365 back. So the refund is prorated for each day that has passed, or in this case, it's $2 a day. So theta is the daily decay in the insurance premium. Now, if we could predict the future, and none of us can, but if we could, there would be no need to buy insurance. So if I'm a bad driver, or if I live in a volatile neighborhood, then my car insurance, my insurance premium would be higher. The more volatile the environment, the higher the insurance premium. And the geeks at the insurance company can calculate the amount of volatility in the overall market, and they tell the customer service people how much to charge based on those market conditions. Let's call this volatility index the VIX, for the lack of a better word. A higher VIX means a more volatile market, which means higher insurance premiums. Let's talk about statistics just for a second. 3 kinds of lies, they say. Lies, damn lies, and statistics. So you walk into this huge party, and you notice that most people are about 5'9". Some are taller, some are smaller. And so you measure their height, and you create a graph, which is a perfectly normal thing to do at the party. And you find that 18 people are 5'9", 16 people are 5'8", 16 people are 5'10", and so on. And this graph is sometimes referred to as a bell curve because it's shaped like a bell. 2/3 of the people in the room are between 5'6" and 6'1" in this blue section in the graph. That's plus or minus 1 standard deviation, this 2/3 area, which means that 1/3 of the people, about 32% roughly, they lie outside the 2/3, outside the plus or minus 1 standard deviation area, 16% on the left and 16% on the right. So if we consider the group of people that we measured to be representative of the overall population, which means you were not at a college basketball banquet where all the people would be tall, then we can make certain assumptions about the next person who walks into the room. So if you guess the next person who walks into the room would be taller than 5'5", you'd be right about 84% of the time. And that's because you see the 5'5" is lined up on the left-hand side of the green section, or the right-hand side of the left green section, where that's the outliers. Now, you might think, well, you don't have to be a genius to figure out that two-thirds or more than two-thirds of the people, 84% of the people, are taller than 5'5". That's true. But anyway, let's just say that this 0.16, with the 16% on the left side, let's call that delta. That's the probability of making a correct guess. We'll call it delta for the lack of a better word. This is not always true, of course. There are outliers. Amanda, Jillian. There are outliers, like a big storm that comes once in a decade, or a huge storm that comes only once in a century. You never know. Nobody can predict the future with 100% accuracy, so never bet the farm. But by using statistics and some other analytical techniques, you can predict the price movement of a stock and be correct more than half the time. So let's review. Premium. It's like you pay insurance premium. That's the amount collected by the seller. Theta, the rate at which the premium decays per day, like your car insurance going down. If you get a refund, you only get a refund for the period of time that you did not use the insurance. Volatility, or the VIX, that's a measure of the overall market volatility. If there's a higher volatility, higher insurance premiums. Delta, that's the probability of making a correct guess. Options. Here's, I think, a good way to explain it. A farmer looks at his crop and he wonders what the weather will be like for the rest of the summer and how much he'll get for his crop at harvest time. Well, each bushel right now should fetch about $32 to $40. So he's talking to his wife about their bills and how it would be nice to know, it would be nice to lock in a price and know how much they're going to get when they go to harvest, which is the third week of the month. In this case, it's the third week of September. And they would like to get a steady price for their crop instead of worrying about what the future might hold. So along comes a rich guy from Maine. We'll call him Richard, for the lack of a better word. And he says to the farmer, I'll sell you insurance. I'll guarantee you $30 per bushel for your crop. You got to pay me up front some money right now. You pay me $2 a bushel up front. That's my bid. And the farmer talks to his wife and says, would you bang your head? We can't pay $2 up front per bushel. Ask him if he'll accept $1. So they settle in the middle for $1.50. That's the mark. It's the halfway point between the bid and the asking price. So the farmer now bought an option. He owns the option of selling his crop at any time to Richard, who must buy it if the farmer wants to. It's the farmer's option. Richard agreed to buy it for $30 per bushel. Well, come early September now, turns out the weather has been okay, and the yield is pretty good. And right now the expected price is $36.50 per bushel. Now, Richard is not a farmer. He doesn't want to take delivery of any bushels of oranges or whatever it was that the farmer was farming on the third Friday of September, the third Friday of the month. So he decides to get out of the contract because the guy time has passed. He doesn't need as much insurance now because it's early September. So the risk is low. He finds a guy, Jimmy, who will take responsibility for the crop. So Richard pays Jimmy 30 cents per barrel, which means he kept $1.20. He originally received $1.50 from the farmer, and then he paid 30 cents. So he netted $1.20, and he's out of the contract. He's all done. He covered the guy's insurance from early in the year all the way up until the first week of September. Now, why sell insurance vis-a-vis options? Here are the S&Ps, S&P 500, an index of 500 stocks, not the 500 largest, but they're pretty large companies. It was $1,500 in 1999, $1,500 8 years later, and $1,500 6 years after that. 14 years are going. do some technical analysis here. Long-term investors don't trade stock. They don't determine the price of a stock today. They buy it and they hold. After all, they're long-term investors like this guy on the right. But the stock market fluctuates based on stock traders. They don't buy it and hold it. They buy, they wait for it to go up, and then they sell it. Sometimes they wait only a few seconds. You've heard of these high-frequency traders. And the market goes back down, they buy it again, and then they repeat. So the market prices are not based on a rational or sound economic analysis like you would think. The market price of a stock is based on the trend, and it seems to be driven more by emotion rather than logic. But an open and active market creates liquidity, and it allows us to get in and out of a stock pretty. A liquid asset is something that you can change into cash quickly, like in a few seconds. A house, although it's an asset, it's not a liquid asset. It takes months to sell it. You can't instantly convert it into cash. So you should only sell options in highly liquid stocks. And typically a highly liquid instrument trades millions of shares per day. Remember this now? It's very trendy, the S&Ps over the past 20 years. You can see on the left side, from 1995 to 2000, it skyrocketed. And it relaxed and it would go up. It would come down, hit that bar, and then go up. And then it went down for 3 years. And then it went back up for 3 years. And then it plummeted in this very now famous financial crash of 2008, 2009. And now it's been on its way back up ever since. The support line is the line, this is the Russell 2000 index. IWM is an ETF that tracks the movement of 2000 stocks. And you can see here, this is a 1-year period where every time it went down to a certain point, buyers would show up and say, hey, that's a pretty good deal. I think I'll buy some. And they would bid the price up. And then it would reach another point where buyers would say, I've got enough money. I've made enough. I'm getting out. And it would trickle back down, at which time buyers would say, I like it. And it would pump it back up and down. A very, very rhythmic, very cyclical thing here. But support and resistance, it doesn't have to be on a horizontal line. It can be on a vertical line. You can see here, the S&Ps would go up. They would reach a point where people would bail out and sell it. It would go back down. People would say, hey, I think I'll get back in. Bid it up again. Very, very rhythmic. Let's take a look at a real life example. Delta Airlines. Not a big fan of airlines for other reasons, but let's just take a look at the chart over a period of 3 years. You can see on the very left bottom side, it reached a point of resistance and it would relax, come back up, relax. Finally, it broke through, a very characteristic image on a stock chart. It broke through, and this is a breakout. And then it relaxed back down on this line, which used to be resistance. Now it's acting as support. You go all the way up to the top center of the chart where on point number 3, it reached a point of resistance and then it relaxed back down again. And then on number 4, it broke through this point of support. Investors had said, okay, I'm getting out. All bets are off at that point when it breaks through support. We don't know how low it's going. Well, the stock did recover. It went back up. And what used to be support now became resistance. You can see in point number 5. And then it relaxed again and became support for a while, except on the very right-hand side, it's a little shaky now. We broke through support. Could be going down. We don't know. Now, it seems like you can draw a line anywhere in the chart and just make up a story. You can, but in fact, if you do this technical analysis, you draw lines on charts, you will see trends. And there's an old saying, the trend is your friend, and you can trade with that trend. Doesn't always work, but it helps. If you choose the right delta on a strike price and sell an option, it definitely helps. This is stock trading. This is not investing. I don't really care. I don't own Delta Airlines. I don't really care if they're going, if the prices are the best or they have new routes going to China. It doesn't matter because the actual stock prices, they're affected by stock traders, not by this perfect economic analysis once again. So we have to check back now in a couple of years to see what really happened to Delta Airlines. Now, on the other hand, if you are a fan of Delta Airlines, I'm not, but if you are, you could sell a put and you could make money if it stays above a certain price. Let's actually place an order. It's confusing at first. I know what you're thinking. At first, Dad, you've been talking a long time. We were confused on slide 2. No, you can. There are only puts and calls, and you can only either buy them or sell them. That's it. It's a put or a call. And in fact, you're going to sell it to begin with. So it's just you're going to sell a put or sell a call. That's it. And if you want to get out of it, you just buy it back. Now, let's look, though, very carefully at your legal obligations because you could get screwed here. Pay attention. This is one of the slides that you should actually pay attention on. If you sell a put, you are obligated. It says, I will buy your stock for an agreed upon price. That's the strike price. The strike price, that's the point at which lightning strikes, the stock went down, and the buyer actually needs the insurance. It's like you get into an accident in your car, you call up the insurance company, you say, guess what happened? Lightning strikes, I need the insurance now. When you sell a call, that means you're guaranteeing you will sell somebody's stock for an agreed upon price, no matter what happens in the future. It's just like when the farmer said, I'll sell you my bushels for $30 a share, guaranteed. So if they were actually selling in the market for 36, whatever, there's already a or if it happened to come out to 26, there's a pre-specified price. So you got to pay attention. If you're selling the contract, you are obligated to take action. Okay, so if you sell one put, that's one contract, that's equal to 100 shares. Make sure you know this. And it's listed per share. So let's say, for example, I was able to sell a put for 49 cents a share. That's the halfway point between the bid and the ask. 47-cent bid, 51-cent ask. And at a strike price, look further on the left, and the white numbers of $41 per share strike price. So if I sell one contract, I collect $49. And if Delta Airlines stays above $41 until the third Friday in August, in this case, I'm the insurance company, I keep the $49 per share. If not, well, then I bought 100 shares for $41 per share. Now, if I wanted to be a Delta Airlines shareholder, then great. You buy it. You're going to be buying it at a discount because you collected the $49 and it was up around $44. So you made a promise to buy it at some point in the future. No problem. Now, there's nothing better, by the way, than owning a stock that skyrockets. You're not going to get rich here selling. The only person who's rich is Richard. And he's going to be rich for the rest of his life because Mom named him Richard. Boom. But you're not going to get rich selling options. Nobody has a crystal ball. Well, maybe there is one crystal ball, and this guy has it. Nobody else has it. So if you're placing an order now, if you want to sell a call, you would go on the left side of the screen, click on the strike price, click on the bid X column that has the strike price that you would want to sell. So here is this would be selling S&P 500 SPY for $217. I'd click on the 52, and then I would push it up to 54 cents, the halfway point between the bid and the ask. Or if I wanted to sell a put, I would go down to the 0.16 delta. By the way, I should have highlighted that. And I would click on the 92 cents, and I would bid it up to 93 cents, the halfway point between the bid and the ask. And I'd be selling a put, which would be, I would hope, since it's a 0.16 delta, maybe I would be right about 84% of the time. If you're going to do this, be absolutely sure that you know what you're doing. The quantity and the negative sign means something. If you sell a quantity of 1, that means you're going to be obligated to either buy or sell 100 shares. Now, you can limit your losses, just like the insurance company says, hey, we're going to cover you up to a certain amount, but that's it. So if you are selling insurance, then you can actually go out there and limit your losses as well. So here's an example. You can do two things. You can either A, have enough money to buy all the stock that you're insuring, or B, you can sell a put at one price and then buy insurance yourself at a lower price. So in this example below, we're selling a put for 204, which means I must buy the stock for 204. But if the thing plummets to like 195, I'm going to find somebody else to buy my stock that I bought at 204. I'm going to find somebody to buy it for 203. Now, this is crazy. It's called a vertical position. I would be losing $1 a share and only collecting 10 cents. But I would be doing that at prices for which I thought I had a good chance of the stock staying above that price. Now, notice the difference. If I sold a single put, sometimes called a naked put, but on the software it's called a single, I would be collecting 87 cents a share. But if I go out and buy insurance for 70 cents a share, 77 cents, I'm only collecting in the vertical spread. I'm agreeing to buy insurance. I'm agreeing to buy the stock at 204, and I'm agreeing to sell it for 203. I only collect 10 cents. So let's review. We sell insurance premium to make money in any kind of a market. We can make money if it's going up, down, or sideways. Just ask Richard. Just choose a direction for the next 2 months. You don't have to listen to the earnings. You don't have to know that the CEO of this company or that company is the best CEO and the markets are going to explode. All that crap. Maybe they will. Maybe they won't. We don't know and we don't care. I don't love any company anymore. They all screwed me. Just wait for the right time. Look at support and resistance. Be patient. And then choose a direction and sell some insurance. Select the strike price that's outside the one standard deviation move. That's at a delta of less than 0.16. And if you want to own the stock, sell a put. If you want to get rid of your stock, sell what's called a covered call. I added this. That was the end of the initial presentation, but you're lucky. I added more. Remember this? This is the very trendy stock market, the S&P 500, where the stocks go up in a bull market, then they go down in a bear market, then they go up in a bull market, then they go down in a bear market, then they go up in a bull. I know it's repetitive. Now, what would be the next word in the sequence if I said bull, bear, bull, bear, bull? The next sequence is a bear. But nobody has a crystal ball except Warren Buffett. So in this case, I could either sell a put. Let's say I go 4% below today's price, 4% below the at the money strike. Or I could sell a call 4% above the at the money strike. It's impossible to predict the future, but let's see. I did a retrospective analysis. If I could get 4% away from today's price for a 1 month period in a bull market, on the bottom left over here, I would only end up buying that stock 10% of the time, 10 or 11% of the time, which means about 90% of the time, I would just keep my insurance premium. I don't really want the stock. I just want to sell insurance. 90% of the time, if I sold puts right here in the bull market of 1996 to 2000, I'd keep my insurance premium. Now, in the bull market, I would only keep my insurance premium 65% of the time. 35% of the time, I would end up selling the stock because the stock exceeded the price upon which I agreed to sell it. A little bit confusing. So, as you can see here, you end up keeping your insurance premium or you end up buying the stock. It's different. If you're in a bear market versus a bull market, it's different. Sell puts in a bull market, sell calls in a bear market. That's the bottom line. I did the analysis going out 2 months as well. A little bit of a change, but the trend is the same. You're much better off in a bull market selling puts and in a bear market selling calls. It means you keep the insurance premium. So for example, over here in the 2000 to 2003 bear market, if I sold calls, I would end up only 90% of the time, I would keep my insurance premium. That's pretty good. This is the last slide here. I know, yay. This is the time value of money. And what it says here in the year 2015, you tuck a little money away and it grows somehow. Maybe it's interest in the bank. Maybe you invest in the next high flying stock. Maybe not. Maybe you sell insurance month after month. Whatever it is, if you start early and you spend a long time doing it, it will grow exponentially. Have fun and good luck.